recording. So I clipped the mic on there. I actually replayed the video from what we just recorded, and it wasn't working any different. So I reconfigured it, and instead of it being on me, it's on the camera. I think maybe the long cable is not working right. It's too far to carry it. So we're going to try it this way. We'll see how it does. Anyway, we were leaving off talking about gains. Let's figure out some taxes. So if I buy a property for $200 and sell it for $245 2 years later, what was my percentage gain? Ooh, I like this one.
45,000 divided by 200.
Yeah, so what is my gain? Well, I'm making 45 grand, right? And so what do I do with that $45,000 in gain?
Divided by 200,000.
So first of all, we can figure out how much we gain. So 245, oops, 245, right? Minus 200, we have 45,000 in gain. Okay, so that's how much we made. Everybody agree with that, right?
Yep.
So now we're trying to figure out, the question's asking what percentage gain. So now I'm going to figure out the percentage, we need to do what in this case?
Divide.
Divide. Now the question is what? Usually everybody gets that far. So what am I dividing and what and where?
Divide 45,000 by 200,000.
45,000 divide 200,000. You agree with that? Why'd you say that?
Because that's just what you do.
That's just what you do. I like it. Okay. So, and what does that give you?
22.5%.
22.5%. There you go. Good job.
Hey, why are you not using the two? Why are you using the two?
And that's where I was leading to.
Yeah,
Why
that's
do
what I'm
you do?
looking for.
Because $45,000 is my profit, right?
Yeah.
So I'm trying to figure out of my 245 what I sold it for. That's my gain. So of my original investment, that 200,000, how much was my gain as a percentage?
So if the question had said, if I buy a property for $200,000, I put $25,000 of improvement in it and sell it for $245, then you would have done 45 divided by 225.
No, you got
No, you would subtract it differently. If you put it.
Because you're saying the capital improvement would be included into your,
Yeah.
essentially your adjusted basis.
Yeah.
You could use your adjusted
Yeah,
basis.
because that's where your gain would be coming from, yeah.
Yeah. And for the most part, they're going to be relatively simple like this.
Okay.
But yes, you're right.
All I did was divide 245 by 200, and I got 1.23, and I just know that anything over 100 is the gain.
There you go. That's one way to do it.
That works too, right?
That does work too.
Okay.
Yeah. So if I purchase property for $450 and sell it 3 years later for $375, what was my percentage loss?
17.
Yeah, see, that's a different problem. Not always a bad problem though, believe it or not. I know that sounds painful, but it can actually be tax benefit too.
Yeah.
So we bought it for $450. And what did we sell it for? $375. So how much did we make / lose?
75.
Yeah. Is that a profit or a loss? Loss. We lost $75,000. So now, how can I figure out my percentage loss? You can do it a couple different ways. I'll tell you the easiest way in my mind, because you have a calculator, as I do the same process. $75,000, you have a negative button on your calculator, hit negative, and divide it by your original investment. Negative 75 divided by 450. What do you get?
17%.
Yeah, I heard 17. I got 16.6.
16.7.
16.7%.
Yeah, I got 17, but
Yeah.
do you not round up to the 90%?
Did it ask us to? It didn't ask us. If it was multiple choice, you'd be able to figure it out. But in this case, you can do it, like I said, a couple different ways as we just talked about. This, in my mind, just makes so much sense because it's the same process.
Yeah.
Just if it's a negative number, hit your negative button. Questions on that?
Well, since you already know it's negative, just
Yeah. Okay, in that case, by the way, that's a 16.7% loss, right? All right, so real estate basic investment. We are on to unit 13. Now, I'm going to try not to get stuck up in here because I get excited about investing in real estate because it is by far my most favorite thing about real estate is investing in real estate. Now, we've talked a lot about financing and financing investment properties. You're not going to get a 30-year fixed FHA on an investment property, right? You're going to get a different type loan. We've talked about the types of valuations of properties. If we're doing a residential property, how are we going to evaluate it?
Sales comparison.
Sales comparison. If we're evaluating a fire department, how are we going to evaluate it?
Cost.
Cost approach. If we're looking at something that makes money, like a rental property, income approach. So hopefully we're going to now take our knowledge and build on that and realize that real estate investment is phenomenal. Talk about some of the pros and cons. I should say there are also cons. I'm a little biased, clearly, but there are always risks with real estate as well. So we'll talk about some of those. We're going to talk about that before tax cash flow. We've already talked about it. We're not going to do the math with it because it's no longer a part of your curriculum, but I'm just going to show you what it looks like. Similar to what we did earlier, just so you're aware of what it means, because we will do it in post-licensing. And then we're going to talk about that cash on cash rate of return. So again, I'm going to move through this quickly, okay? Because, one, we've talked about most of it. Two, this big chunk of what I'm about to talk about is no longer on your test. You're not tested on the before tax cash flow. Which, when you see it, you'll be thankful. Don't file it away, though, because you may see it one day. All right. So pros and cons of investing in real estate. Again, there's the appreciation part of it. It's going to provide some possible passive income if you have rental property and it cash flows. It does diversify your portfolio. A lot of people who have money want to invest it in things so that it makes money. That's the entire premise of managing money. How are you taking your money to get it to make money? And so real estate gives you a platform to do that. It does require cash oftentimes to get invested. That's a con. It can be labor intensive, especially if you're doing your own property management or your own flipping. Your property is not liquid. Your cash is not liquid. So if you need to go to the bank and take some cash out of it and it's tied up in real estate, you're not going to be able to get that out. Before tax cash flow is the exact same process we talked about. We're just going to take out that debt service. That's the only additional step. And that before tax cash flow is what the owner of the property is making. That's their income before tax. Leverage. Leverage is simply defined as other people's money. And we actually, Thomas is not here, but this is the reason I love investing is because you can make money in real estate with other people's money. And a lot of you in the room are like, oh, I don't have the ability to do that. Yes, you do. If you can buy a house to live in, you can buy an investment property. You live there for 2 years. You get your gains tax-free, and then you do it again. That's how I invested in real estate. I had no money when I started real estate. Believe me, no money. I started in the recession. No money. If I had not invested in real estate, I wouldn't be where I am today. So being able to use the mortgage or loans, other people's money, where can I buy a $100,000 house, put $20,000 down, and 20 years later, it's a $150,000 house that someone else paid for? Right? I had it rented all those years. Now someone else has paid my mortgage off. It's great. And if I did it right, I made a little money along the way and all the tax benefits that we talked about. So great. Great. I get excited about investment in real estate. So we talked about equity. What is equity?
That's what you have in it.
It's not necessarily how much you have in it. I know where you're going with, but specifically.
Value minus debt.
The value minus what you owe. Yeah. It's not because she said what you have in it. And that's, I know what you're alluding to, but be cautious because it's not necessarily how much you have in it. It is how much the difference between what it's worth and what you owe. And so we can increase that equity 3 ways. What are the ways we can increase equity? Pay down the loan,
Improve the property.
improve the property,
Improve the market.
or let the appreciation improve the market for you. Those are the 3 ways you can get improved equity. Yeah, put them right on the screen for you. How awesome is that? Or on your book, wherever you're at. No. Yeah, it's there. All right, so let's talk about a couple other vocabulary, really strictly. We're going to talk about syndicates. Syndicate is a pooling of money, where you have multiple people or entities with money putting it together to invest. Syndicates are often these hedge funds that invest in mortgage-backed securities or possibly buying properties, right? So there's those pooling of money. Syndicates, 2 or more people put their money together to operate an investment of any kind. And then in real estate specifically, we have these REITs, real estate investment trusts. And that is your hedge funds, where they're taking a lot of trust money from retirement accounts, things like that, and they're buying real estate or buying mortgage-backed securities, somehow investing it in that real estate world. So REITs are real estate investment trusts. And that's another reason people say, hey, I can't invest in real estate. Well, if you may not have $100,000 to buy a house, but you might have $5,000, and you can get with other people who have $5,000 and create this investment trust. Pool your money. That happens. Just be careful with who you get in business with. Couple of things to be concerned about when doing these types of investment collaborations are laws that are essentially designed to prevent predatory investments or people creating things and selling them that really have no merit. So only thing you need to know about this slide is that blue sky laws are going to be within your state. A lot of times they have to do with interest rates and fees and things like that to keep exorbitance from getting out limits. And then SEC laws are the national version of those investment laws. So SEC is national, blue sky is state. These laws are meant to govern multiple types of investment, but REITs and syndicates and those types of things are included. Now, real quickly, we're going to talk about formation of a new entity. When I say a new entity, you are an entity as a person. You are going to be a sole proprietor in one person show, likely. However, as you become more productive, you may decide, hey, I want to be more than that. And you could form another entity called a business, right? Your business could have several different shapes and flavors. One of which might be an LLC. One of which might be an S corporation. One of which might be a C corporation. Now, for your business, as real estate brokers, you are likely going to see more LLCs and S corporations and sole proprietors. Your C corporations are really your large corporations, your Pepsi Colas and big brands. Those are your C corps. The best thing about these entities, and if you've ever built any business at all, whether it be yard care business or tax business, anything like that, if you want to create a business, you will go file some paperwork. Where would you file paperwork in North Carolina to do so?
Secretary of State.
North Carolina Secretary of State. So with the North Carolina Secretary of State, you will file articles of incorporation, and you will incorporate this new business. And all of a sudden, North Carolina will represent this, or will recognize this new organization as an entity. It's like giving birth to an artificial person. And it really is, because we have social security numbers, right? Your new entity will get an EIN, an employer's identification number. And that is the equivalent of the social security number for your new entity. Make sense?
Will you tell me that paper that they create? It's what?
Articles. of
Articles,
incorporation.
yep, articles of incorporation. You're just filing the articles, as we call them. Now, what are you trying to get from this class in order to receive commission income?
License.
A license. You are a person who needs a license to receive commission income. If you are giving birth to an artificial person, what would they need to receive commission income?
A license.
A license. What kind of license would this get?
Entity license.
Entity or a firm license. So your companies have firm license and will be required to have a firm license. Because again, where does all the commission money go?
Firm.
To the firm. In order for that firm to receive that money, it has to have a license too.
So do they have to take the test?
They do not have to take the test. They do have to have a qualifying broker who did, in fact, start the firm and apply for the license.
And you
So-
can't be provisional. You have to be non-provisional by that point, right?
2 years.
Well, there's some rules around that.
Oh, okay.
To answer your question, technically, yes, there is some exemptions. So as we give birth to these artificial entities would have to have a firm license in order to receive commission income, just like we would. I also pay the $45 for them every year. I have my firm, Carolina Crew Inc., as a licensed firm, and I have to pay $45 for it to receive commission income, as well as $45 for Stephen to receive commission income. All right, so we're going to go through a couple of the options. The first one is a sole proprietor, and this is probably what majority of real estate brokers are. You are a person and entity at the same time. It's just you. You didn't file anything with the Secretary of State. You didn't create any new artificial person. You and your social security number are the business. Now, a couple of caveats with this. First of all, don't ever. This is just not safe. It's just not safe because you are personally liable for anything that goes wrong. And when I say personally liable, that's your house, your car, your retirement, everything all of your assets,
All attachable.
everything attaches to that sole proprietorship. Now, contrary to most of the belief in this room, as a real estate entity, I can be a sole proprietor, right? This is the part that will blow your mind. I can hire every one of you to be brokers at my sole proprietorship. The difference is that, remember in the previous slide we talked about giving birth to a new entity, right? That would employ everyone here in a firm. And a sole proprietor, I am the entity, I am the firm. So, it's allowable, but when I tell you I'm personally liable, and all y'all are underneath me, everything you do puts me personally liable. Not a good idea. Is that what you were going to say?
That's what I was going to say.
Yeah, this is not safe.
It's like, don't-
Not safe. There is times where this is more appropriate if you're not going to do a ton of business. If you're just going to be a one-person show and you want to be responsible for you, that's okay. Still advise consulting with your tax professional and your legal professionals, because I think you will find this, even as you, is not safe. One of the biggest benefits of an LLC or any entity is it's not you. Between let's say Sally is a deal gone wrong, right? Something went wrong there. Kayla is my entity. She's my LLC. Stephen is over here. Sally can't get to me without going through Kayla. Make sense? Now, it doesn't mean she couldn't, right? She could push her down and come on. But she won't slow her
Because
down.
you're probably the only member manager.
Yeah, because I'm still probably somewhat engaged in this, but it's going to create a little bit of a legal shield that's going to slow it down. That she's going to have to sue and come through the assets and come through that entity before getting to me. Whereas if I am the sole proprietor, she can just come straight to me. And that's much easier for engaging in lawsuits too. And also, again, more risky. So
Well,
sole proprietors can be risky.
Also, the LLC doesn't have your car and your house and everything attached to it.
Right.
It's totally
It
separate.
Yeah, because when
Accounting.
this entity screws up, you have to sue this entity.
Right,
Which
Not
probably
me.
has no assets.
And when there's no assets, so it goes out of business,
yeah,
and now you're out of luck.
yeah.
Which is also why you hear complaints about, oh, my builder done me wrong, and they did this, and then the builder went out of business. Well, guess what? You got no recourse. The builder's out of business.
And they moved again.
Yeah. Yeah, and we had a lot of that in the recession. Oh, my builder had this 5-year warranty, but they went out of business after their first year. That warranty's not very good. So you just have to keep those things in mind and know that from either being the LLC and having one or working with one, you do have some extra levels of protection or obstacles if you're going to go that route.
And it's surprisingly easier than people think to establish an entity. It's literally a page
Oh,
and
yeah.
a half document. It takes probably 30 minutes for an average person to fill it out. You can get an attorney to help you, but it's super easy.
do it on
I just did 3 nonprofits last month for some bands I'm in. Super easy.
Yeah, and honestly, it is, like he was saying, the Secretary of State is all online. If you don't do a ton of them, I can actually create an LLC, file the articles with the Secretary of State. It spits out and says awesome, and then I go to the Employment Security Commission for North Carolina, and they give me an EIN online. I never have to leave my office, and I have now I just gave birth to an artificial intelligence and never left my office. So it's easier done. And actually, you'll find that a lot of your investors will do this. I have a lot of folks who will put each rental property that they own in an LLC. 123 Main Street, LLC. 1234 Main Street, LLC. And they'll have different, we call them almost like baskets, different eggs in the basket, so that if there's ever a suit, they can't come after the whole basket, just some of the eggs. Yeah.
I put them all in my personal name
Mhm.
and then use the business to do the repairs.
Yeah. You can do that.
And yeah, that way it's my property,
Mhm.
but at the same time, it's like, okay.
Was that-
Something went wrong, that sucks.
Yeah, and then
It's
worst.
got no assets, here you go. You want
Yeah,
it, you can have it.
because if you don't, and that's the other thing too is,
Yeah.
and from a business standpoint, obviously I'm not an attorney, I'm not an accountant, I'm not necessarily giving you advice on this, but I don't own much. My company owns a lot of stuff. So if somebody wanted to come after Stephen, good luck.
Why don't you own anything?
Well,
Liability.
liability and for tax purposes.
It's a transfer of liability.
Yeah, my company makes all of my money. I'm just a salaried employee.
Also makes it easier for you to get loans, because when you go to the bank as a W-2 employee of a company,
And this is the real benefit of this entity is getting loans. I mean, it's one of the from a real estate perspective, and that's why kind of circling back to Steve's question. He was like, "Oh, you've got a." Let me just black that because I didn't apply to him. So when you're applying for kind of this firm license, so to speak, all of you, once you are 2 years in the business and have dropped your provisional, can have your own firm. I'm sorry, you don't have to be 2 years in business. Once you have dropped your provisional status, you can all have your own firm. Now, some of you may not meet the requisite qualifications to be a broker in charge. A broker in charge has to have 2 years full-time experience out of the last 5. So you may not have that. However, you might drop your provisional status in 3 weeks. You have 30 classes, 30 hours a week, right? 3 weeks later, you're done. You can do it. Many brokers will file a firm as an LLC for the exclusively for the purpose of receiving commission. That's what we call a silent LLC, so that you can put your commission money in an LLC, and then you pay yourself from that LLC. And what that does is it avoids the self-employment tax.
So do you have to be a broker in charge to do the LLC that
The
way?
silent LLC does not, is the only firm on the planet that does not have to have a broker in charge. Every other firm, every other entity, if it's going to have a real estate license, has to have a BIC.
Do they have loud LLCs and quiet LLCs?
Well, I say silent because you cannot market it. No one can know it exists. It's you. You're the only employee. You can't put it out there. You can't put it on a sign. You can't put it anywhere. So it really does exist silently in the background,
So it's just-
solely for the purposes of you having a bank account to put your commission money in. And
but
that's
you
the
also
only
have to have, don't you have to write your agreements in that name too, though, or no?
Not that one.
You don't?
Not
Okay.
that one. Not that one. And
So
it
it can
is,
truly stay silent.
it's essentially like making a copy of yourself. It's just a legal copy of yourself that has its own EIN, so all your money goes to that company.
But when somebody
And then you
writes
pay
a
yourself.
check, then it goes to the LLC.
It would go to the LLC. And then you write yourself a check from the LLC.
And you can also be an employee of the LLC?
Yes. Yes.
So, okay,
You
so
actually can be the only employee of the LLC because the moment I hire someone else in my
you have
LLC,
to have a BIC.
it's not silent anymore. Somebody knows about it. So then I have to have a broker in charge.
Okay.
Yes, sir.
Now, do you, when you do your taxes, because like when I do mine, I file a loss on the business every time,
Yeah.
and
Well, and that's like the benefit of having an LLC for each rental property. Because if I own 500 rental properties and I show a loss every year, IRS will go, what you doing wrong, bro? But if one does, and one does, and one does, then that makes more sense. So yeah, and that's why I said I'm not a tax guy. Don't pretend to be. I don't even know what taxes, how they work. I just pay people and they make it happen who are smarter than me. But I do know that in order to have some of these entities that we're about to talk about, you may have to do some extra steps, like getting this firm license. But sole proprietor, you're personally liable. It's dangerous. Partnerships, also dangerous. If you're going to be in a partnership, make sure you know who you're getting in a partnership with, because they rarely work out, to be frankly. My sister and I are partners, mostly because we're brother and sister. We really can't get rid of each other. So we have been partners for 15 years. A partnership comes in a couple different flavors. You can be a general partner. General partners are personally liable for the whole entity. So if you are in an LLC, for example, or a partnership, and the partnership is getting sued, you are responsible as a general partner for that. Right? You have, if the general partnership goes bankrupt, you are responsible for that as a general partner. Now, limited partnerships, when you have a limited partner in a limited partnership, the limited partner is not responsible for all of the partnership. They are only responsible for the portion that they have invested. That make sense? So general, doesn't matter how much you invested, you're responsible for all of it. Limited, you're only going to be responsible for how much you put in. So that's partnerships, and partnerships can own real estate in North Carolina. C Corp versus S Corp. Again, C Corps are your bigger corporations. They're your huge corporate conglomerates. S Corporation, I'm actually an S Corporation, in North Carolina to receive or to gain some of the some of the tax benefit, you have to be a subchapter S here. And I didn't know this, but at the time, an LLC can actually file with subchapter S status. Didn't know that. So we went with S corp. Turns out it was okay. Either way, this is, you can do it in any capacity that you so choose or that you're advised. But an S corp is where the income is still going to flow through like an LLC to you, and an LLC too, by the way. LLCs, limited liability corporations, are you. They're just an extension of you. So if the money flows through an LLC to your personal tax return, and that's the subchapter S, that's what it does. It makes the money flow through to you. The benefit of it is, and like for my example, where I have an S corporation, if my S corp makes $100,000 a year, and we pay $30,000 to a salary, and we pay $40,000 for operating expenses, then I'm only taxed on what I draw as my salary, right? And then the corporation gets taxed on any profit. But like Thomas was saying, we usually have enough expenses.
There won't be any.
There's very little profit. Because my salary is an expense to the corporation. So there's benefits to it. Now, yeah, my salary is everything. And actually there's a lot of that stuff that goes on after this class. I just really need you to get the fundamental levels of how an entity is created, Secretary of State, how it has to have a license if it's going to receive commission income, and your limits and liability versus kind of what it is, versus sole proprietor being most liable personally, up to S corporations and C corps that can have some additional benefits. Remember our NOI conversation that we had earlier. So if you are looking at this slide, you can actually scratch out the next several slides, because I'm going to show you what before tax cash flow is, which we've actually already talked about, but you will not be required to calculate it.
There are no. Yeah.
Oh, there are no
You
more?
took them out.
Oh, sweet, took them out of there. Great, that's all you need to know.
So where's our?
Good, that's all you need to
Scratch out
know.
the rest of the white page.
That's all you need to know, because the before tax cash flow conversation ensued thereafter, which we kind of touched on, which is all I wanted to do anyway. Questions on that? Yeah, sweet, we're out of there. Cool, let's go to our 75% slides officially. Yeah, we're moving around the call. Come on. Yeah, if my computer cooperates. There we go.
Which one?
Come on.
They're not all done. Just start. You'll have to pull them out of the sleeve.
That's the, oh, there it is. That's it, that's the 75%. That's not. Oh no, because we're in the 100.
I was gonna say, did
Sorry.
you want 100?
Yeah, thank you. It's the drugs talking. Where's my 100%? They actually go to a nice white background, so hopefully you like that. Actually, why don't you guys go ahead and take your 10-minute break and I'll get pulled up. We'll just take a little early break.